Okay, so hi guys. I hope you people are doing well. First of all, thank you very much to all of you for joining in at such a short notice. We just announced the session during the day today because I'd been getting queries from the students, so I thought that maybe I should have a session. And so that's basically thank you for all of you that you people have joined in at such a short notice. And I'm hopeful that inshallah, we will have a productive session through which we would be covering some of the latest examination questions also, and we'll be trying to discuss that how exactly should you be answering the question and different things like that. And I'm not committing, but I would try to see that if I can have another session tomorrow also. I'm not committing. I'll just try to make sure that I conduct one more session tomorrow so that it could actually become more fruitful for all of you. So I have in front of me the ACCA CB practice platform. And on this ACCA CB practice platform, I've actually opened up the March-June 2023 examination paper. This is the latest examination paper that is available on the ACCA CB practice platform. And what I'll be doing is that I'll be trying to do the questions pertaining to this, plus some of the students. Yeah, good evening, Hanina. So plus in addition to this, some of the students wanted to know about the answers for the ACCA mock that the ACCA has published. So I'll be probably doing a recording of that tonight or maybe in the tomorrow morning. So that's probably going to be available tomorrow morning also. So I'll just try to make sure that it is made available to you people. So I'm just going to start off. Just allow me 2 more minutes. I'm going to start off. Okay, so let's just start off now. We're going to start off with this. The first question, which is actually about the Joshua company. It says the following exhibits available on the left-hand side of the screen provide information relevant to the question. Joshua company, acquisition of Fraser company, share buyback. It says this information should be used to answer the question requirement within the chosen response options. Okay. Now, what are the requirements of the question? So amongst the different requirement of the question, I'm just going to copy all the requirements and I'm just going to paste them onto my word processor so that I have the requirements in front of me whenever I wish to have them. So here it is. It says discuss the agency problems associated. I'm not actually splitting the second requirement right now. Okay, this is the first requirement. It says discuss the agency problems created by Joshua Company's proposed takeover of Fraser Company as a defense and risk diversification strategy and explain how these could be mitigated. Now, first of all, I would want to discuss here. I've not actually started to read through the whole question. But I personally think that generally, I mean, even looking at the examiner's comments also, the examiners, they mention this thing that a lot of students, what they do is that instead of focusing upon the core area of the question, which is here the examiner has focused upon what? He has focused upon the agency problems created by Joshua's proposed takeover of Fraser Company as a defense and risk diversification and explain how those could be mitigated. So a lot of students, what they would actually do is that they would actually focus upon here and they would start talking about the diversification issues and etc. etc. So this is not what is needed. What actually the examiner is asking you is that he's focusing upon the agency. So he's focusing upon the agency problems. That's what his main area is. And you have to talk about the agency problems. So first of all, always try to make sure that you understand what is the examiner asking you to do. Can you just please confirm that the audio is clear to all of you, right? So first of all, you people need to consider that what is the examiner asking? The examiner is asking you about what? The examiner is asking you about the agency issues. Agency issues. And you know what these agency issues are? Generally speaking, the agency issues are between the shareholders and the managers. Between the shareholders and the managers, that's what generally it is all about. Now let's talk about that. What is he asking for? So I'm not actually answering down this question right now because I think that this is one of those questions that we would be able to develop the answer as we move on with the scenario. So I'm not writing down the answer to the question right now. And I would do that in the examination also because I don't see any specific exhibit for this. I don't see any specific exhibit for this. So I would not actually go about doing this right now. I'm just going to highlight it. I'm just going to leave it alone right now. I'm going to come back to it later. The second one of them is it says prepares a report. Prepares a report for the Joshua company that calculates post-acquisition weighted average cost of capital. That's number one. Number two, estimates the additional value created uh, post-acquisition, compares shareholder wealth before acquisition by calculating percentage change in equity value and the next year's dividend income for both shareholders, and then advises the board of any concerns that the shareholders may have with the acquisition and so on, so on, so on, so on. Then it says discusses the credibility of the CEO's alternative suggestion to share buyback as a takeover defense and so on. So then professional marks are going to be awarded. So if you look at this, these are all the requirements of the question. These are all the requirements of the question, right? Now see, what I'm actually going to do is that I'm going to read the requirements through these exhibits. And I am assuming that while I'm reading these exhibits, I will automatically get the answer to part A also. So let's try to do it together. Let's try to read it through. We know one thing that we have to calculate. What do we have to calculate? We have to calculate post-acquisition weighted average cost of capital. That's one thing. Now, can you just read through it? Can you just go through this area, please? Okay, now it says Joshua Company is a listed leading fashion retailer with stores based in flagship retail centers nationwide. For many years, Joshua has been highly popular, but its financial performance has suffered recently due to the problems associated with its online operations. So there have been problems with its online operation. These problems are causing concern for the company's institutional shareholders. So who is actually concerned? The institutional shareholders of the company are concerned because of the problems with the online operations. Online rivals have emerged in recent years and are quickly reducing Joshua's market shares. These companies have also successfully diversified into other areas such as household furnishing once they've established a well-known brand. Joshua recently attempted to acquire one of those rivals, Fraser Company, but neither the company's shareholders approved the deal on the grounds that it was unlikely to create a value. Okay. Following a series of profit warnings, there has been an ongoing media speculation that Joshua Company is attracting takeover interest. There has been no approach made so far, but Joshua's directors are concerned about the implications for their future in the company. Joshua's chairman would like to discuss defensive strategies at an upcoming board meeting, particularly the suggestion that Joshua could defend itself against the takeover by improving its own takeover offer for Fraser Company. The rationale for this suggestion is that it would be much more difficult to acquire and enlarge Joshua Company. In addition, this would also introduce a risk diversification benefit into Joshua's operations. Now, see what is actually happening. The examiner is actually asking you in the scenario, discuss the agency problems created by Joshua's proposed takeover of Fraser Company as a defense and a risk diversification strategy. Now, where does the agency problems arise? You need to understand that. Now, I am just going to list down that what is the directors willing to do? What are the shareholders' concerns? The directors, they are willing to protect themselves, protect company from hostile takeover, concerned more about their own positions, right? Whereas when it comes to the shareholders who are technically the principals, the directors, they are the agents, and the shareholders, they are the principals. They are concerned about suffering financial performance. They are concerned about problems in the operations having an adverse impact on the company. They are concerned about the falling market share. So they have got different things. Now see, what happens is that now let's just try to understand. See, again, I'm just going to tell you the examiner says discuss the agency problem created by Joshua's proposed takeover as a defense and the risk and how these could be mitigated. So now just try to understand. The directors are the agents. So you could just see, you could use these pointers. You don't have to just list down the pointers. You have to elaborate the pointers. You have to list down the concerns of the shareholders. Now, there seems to be a clear divide amongst the objectives slash goals pursued by the shareholders and the directors. This is a classic example of the classic example of the agency issues that could arise in an organization. In order to mitigate these issues, there is required to be a clearer communication between shareholders and directors. The directors need to be assured about their positions in the company and the expectations from them. The shareholders, the overall approach of the diversification should be pursued if it is in the best interest of the entity. So you get my point. This is basically you're going to be talking about these directors and the shareholders issues, and then you would be going ahead discussing that what should be done. So you would be creating a ground for yourself that look, this is where the problem is. They've got other objectives. The directors have got different goals. The shareholders have got different goals. The goals and objectives of both of them are altogether different, and this is actually causing an issue. And in order to tackle this issue, there has to be a clear communication. There has to be a clear communication between them in order to take things forward, right? Okay, now next is that prepare a report for the board of directors of Joshua Company that calculates the post-acquisition weighted average cost of capital. So you know that if you have to draft the report to, from, subject, date, and then what you have to do is that you have to give an introduction. In this introduction, you say this report. So you have to reword majority of the requirements, right? Report calculates the post acquisition weighted average cost of capital for Joshua Company and discusses and estimates additional value created for the shareholders, comparing the wealth before and after acquisition. The report further addresses the concerns of the shareholders, concerns that the shareholders may have. See, I'm actually picking up each requirement one by one. I've covered up this, so I'm now covering the fourth requirement. In relation to the acquisition and discusses the validity of the assumptions made for the above evaluation. The report is then concluded with the consideration of the proposal to the share buyback suggested by the CEO. So what I've done is that I've just used the requirements, and on the basis of the requirements, I have actually reworded the whole of it. You can copy paste. It's just that make sure that it makes a bit of a sense. It's just like it gets into the flow. It's just not like the copy pasting that you are doing. Just try to make sure that it looks like, okay, you have put in some effort, right? So just try to do that. Now, okay, lovely. Now what next is there? So acquisition of Fraser company is what we have. Um, can you just read through this part, please? Can you just read through this part first? Okay, let's just start. Now, see, what happens is that, yeah, it's 5 marks is enough. I've discussed, I mean, you see, I will be discussing each and every pointers of this in short paragraphs. I'll be discussing director's issue. I'll be discussing the shareholders issue, and then I'll be having this discussion. This is sufficient enough for 5 marks. Now, it says Joshua's funding options have deteriorated significantly since last year's cash offer for Fraser Company was rejected. It no longer has the cash reserves required to fund another cash offer, and the shareholders are unlikely to agree to a rights issue so soon after the last attempt, which also ended in a failure. Okay, so now there is a problem. Basically, the shareholders, they don't want to contribute because they have had a bad experience with the company, which also ended in a failure. In addition, Joshua's gearing significantly exceeds the industry average. That's another problem that they have. And the company is closing to breaching one of its covenants. Now, the CEO has therefore suggested a new offer is made based on a share for share exchange. The following information is available, including brief extract from both companies' most recent annual reports. So Joshua's annual report is given. Then Fraser Company's annual report is given. You've been given the market value of equity, the asset beta, the dividends are being given, the ordinary shares are being given. So you know that what are the ordinary shares, and $1 is the par value of these ordinary shares that's given to you. Now what next is there? Let's try to understand this. The next situation is that it says Joshua's company's post-acquisition beta can be assumed to be the weighted average of both companies' pre-acquisition asset betas weighed in proportion to their market value of equity. In their market value of equity. The board intends to maintain the company's existing debt to equity ratio of 30/70 based on the market value and expects pre-tax credit spread on Joshua's debt to remain at 410 basis points above the risk-free rate, if Fraser is acquired. Okay, so there is some information in here, but we have the market value of equity is given to us. The asset betas are given, the dividends are given, the ordinary shares are given, but we're not being given the debt. We're not being given the debt value. But it says board intends to maintain existing debt to equity ratio of 30/70 based on market value. So the existing is Joshua is 30/70. We're not being given about the we're not being given about this company, the Fraser company. You'll just look at it. That's what's happening with Fraser company. Um, okay. According to finance director's forecast, Joshua will earn profit before interest and tax of this. It is assumed tax allowable depreciation will be this. Okay, share for share exchange and post dividend. These are all something that's gonna be covered up later. Now both companies pay corporation tax at 18%. Risk-free rate of return is 3.7%, and the market risk premium is 8.1%. So market risk premium is 8.1%. That's what it is. Now what is it that we need to do? So we actually have to say that, okay, how exactly is it going to be done? I'm just looking at somewhere if we could be given the Fraser company's debt to equity ratio, but I think that no information is given. So we'll just assume that the Fraser company also has the same debt to equity ratio as that of the Joshua company, or what is actually expected to be. Um, okay, now let's just see. So what is going to be the approach to calculating this post acquisition weighted average cost of capital? What approach are you going to adopt? What approach are you going to adopt? Yeah, what should be the approach, please? Can you people suggest what should be the approach to calculating the weighted average cost of capital?
You need to identify the variables.
Okay, lovely.
Cost of debt and equity. The market
Okay.
values.
Okay, so now how do we go about calculating the cost of equity?
You use CAPM.
Okay, but do we need to do another step for using the CAPM?
The equity, the beta.
Asset beta, right? So that's one thing which is going to be something that we would have to cover up. Now, first of all, in order to do the calculations on this, let's just try to understand that for the calculation of weighted average cost of capital, you have to define the variables, right? You have to define the variables. The KE needs to be calculated. For the KE, we need the risk-free rate of return. We need the asset beta. We need the market rate of return. And we need RM minus RF, right? Similarly, what do we need? We need for this. Okay, so this is something that we would have to do with respect to the cost of equity calculations. Now, the second thing for that is that we need to have the KD, we need to have the tax, then we need to have the KD 1 minus T. Plus, we need to have the market value of equity, we need to have the market value of debt. All of this is required for us to be able to calculate the weighted average cost of capital. Now, we know this thing that this is going to be 0.3. We know this thing that this is going to be 0.7. That's what it is going to be. We know these things. But what do we need to do with respect to the things over here? We have got the information about Joshua. We have the information about the Fraser. The asset beta is given for Joshua. The asset beta is given for Fraser. So the first step that you have to do is that you have to calculate the weighted average asset beta. The weighted average asset beta is going to be calculated how? The weighted average asset beta is going to be calculated like this. In order to calculate the weighted average asset beta, you would say the asset beta of Fraser, asset beta of Joshua, market value of equity of Fraser, market value of equity of Joshua. Now, the market value of equity of Fraser and Joshua is given to us 56 and 102. 56, 56, 102. The asset beta of Fraser is given as 1.18 and that Joshua of 0.85. So what are you gonna do? You're gonna say that, okay, what is the sum of both the market value of equity? Sum of equity value is gonna be this plus this. It's actually 158. Now what are you gonna do? In order to calculate the weighted average asset beta, you would do the calculation like this. You'd say number one, the bracket open, Fraser 1.18 multiply by the market value of Fraser divided by market value of equity of Fraser and Joshua plus bracket opens the market value, the asset beta of Joshua multiply by market value of equity of Joshua divided by the market sum of the market value of equity of both of them. So hence resultingly what happens is that this is what you would get. You would get 0.97 as the asset, 0.97 as the asset beta, weighted average asset beta. So for the KE calculation, the asset beta is gonna be this. The risk-free rate of return is already given to us in the question, and that is 3.7%. That is 3.7%. The market risk premium is given to us, which is 8.1%. So you don't need to use this RM because it's not needed. If you have to calculate the cost of equity, it is going to be the risk-free rate of return plus the bracket open, okay, sorry, just a second. This is the asset beta. We need to convert this into equity beta also. Just a minute, error on my part. Now we have the asset beta. So now what happens is that what will be the estimating equity beta of the combined company. So in order to calculate the equity beta, you need to have the asset beta. You have to have the market value of equity. You have to have the market value of debt 1 minus T. You need to have E plus D 1 minus T. So what actually happens is that the tax rate also needs to be there. The asset beta is already available to us, which is point this whatever that is. The tax rate is given in the question and it was 18% the tax rate. Tax rate is given in the question which is 18%. The market value of equity is 0.7, right? Because we are being told that the combined company would have a gearing of how much? 30 to 70, right? The debt 1 minus T is gonna be 0.3. Is gonna be equal to 0.3 multiplied by 1 minus the tax rate. E plus D 1 minus T is gonna be this 0.946. So the equity beta is gonna be asset beta multiplied by E plus D 1 minus T divided by E. Hence, the equity beta is gonna be 1.306 so and so, so and so. So we have got the equity beta also. Now if I go a bit further, so I have got the equity beta, and the equity beta is gonna be this. So on the basis of this, I can calculate the cost of equity, which is risk-free rate of return plus the bracket open equity beta multiplied by market risk premium. So hence resultingly 14.28% is gonna be the KE. That's also another important calculations for our workings. So we have the KE. We need to establish the KD1 minus T. Now, what is the KD? The examiner says that the market risk premium is 8.1%. Okay. He did tell you about the debt. He says the expects the pre-tax spread on Joshua's debt to remain 410 basis points above the risk-free rate. So it's actually gonna be 4.1% plus the risk-free rate, 7.8%. So if I calculate the KD1 minus T, I would say this multiply by bracket open 1 minus T. So basically what happens is that you've got the KD1 minus T to be 6.4%. You've got the KD1 minus T to be 6.4%. Now, so what can we do? We can now calculate the weighted average cost of capital. Okay, in order to calculate the weighted average cost of capital, we know the KE is this multiplied by 0.7 plus, sorry about it. It's gonna be equal to 0.7 multiplied by KE plus 0.3 multiplied by KD1 minus T, which is 6.4%. Hence, resultingly, this is your combined weighted average cost of capital is going to be 11.92%. 11.92%. Yeah. So do you people understand this? Yeah. Do you understand this? Okay. I'll just show it again. See, what was the approach that I have adapted? The first thing that I did was I actually listed down the things, but my first point was to calculate the weighted average asset beta. How did I calculate? I simply said, like rather than inputting everything in the brackets, I try to do the calculations for the numerators and the denominators. So I had the asset beta. I had the asset beta of Fraser and Joshua. I had the market value of equity and Joshua of equity of Fraser and Joshua. I summed them up, and on the basis of that, I established the weighted average asset beta. Now what actually happened is that there is a formula for the equity beta. In case if you are lost in the examination, there's this formula button also. Just go there, go to the formula sheet, and you can have the formula again here. See, this is the formula. Its asset beta is equivalent to so and so, so and so. So when you make this equity beta a subject, this goes on that side, and this is how it goes about. So this is what I did. It's asset beta multiplied by market value of equity divided by The market value of equity plus debt 1 minus T. So once I got this equity beta, I use this equity beta for the estimation of this equity beta. I use this for the estimation of the KE. For the KD 1 minus T, I actually did simply this debt 1 minus T. And then we have got the weighted average cost of capital. So are you people okay now? Okay, lovely. So we have actually done this first part of the requirement, and that was calculate the post acquisition weighted average cost of capital. The post, okay, using the calculation, the post acquisition weighted average, you see, or you could just do it like this, like again and again, rather than using this, you could just reference it once. The post acquisition weighted average cost of capital. The post acquisition weighted average cost of capital for the Joshua is estimated to be 11 point, how much percent was that? 11.92%. 11.92%. 11.92%. Refer spreadsheet for calculations. Now, the second is estimate the additional value to the shareholders from Joshua for proposed acquisition. Now, these are the post acquisition cash flows, and he's asking us to calculate the additional value to the Joshua. So can you just read it through, and do you know how will you do it? Okay, so let's just start off. Okay, Talal, I'll try to see what best could be done. Now see post-acquisition cash flows. It says according to the finance director's forecast, Joshua will earn profit before interest and tax of 27.2 million in the first year after the acquisition, growing by 5% per year in the following 3 years. So there is basically will earn profit before interest and tax of 27.2 million, right? In the first year after the acquisition, growing by 5% per year. It is assumed tax allowable depreciation will be equivalent to the amount of investment needed to maintain existing operations. However, an investment in assets of 2.7 million will be required in year one, and then a $2.13 per $1 increase in PBIT from years 2 to 4. So there is going to be an investment in assets of 2.7 million will be required in year one. Okay. And then $2.13 per $1 increase in PBIT for the years 2 to 4. It is expected that the acquisition will create after-tax synergies worth 9.2 million per year in each of the first 2 years. From year 5 onwards, the company's free cash flows are expected to grow annually by 3% for the foreseeable future. Now, there are a few things that I want you people to identify because the students at times they make an error, right? Now, what exactly are the errors that the student makes? See, this is specific synergy that's being discussed here. This is just applicable for 4 years, whereas the cash flows are expected to arise up till infinity. So if you mix up both of them, you will make an error. If you mix up both of them, you will make an error. What is the suggested approach? The suggested approach is that don't mix it up, just keep them separate. Don't mix it up, just keep them separate. Just try to ensure that you have a separate, just try to make sure that you have a separate workings for both of them, right? So that's what you would have to do. Now, how would you do that? Let's try to understand. It is going to be like this. It is going to be like this, that you would say that, okay, if you have to do the calculations, the free cash flows to firm, the profit before interest and tax. This is year one, this is year two, this is year three, this is year four. Now, so for the year one, this is expected to be, for the year one, it is expected to be 2.13 million. 27.2 million. 27.2 million. And this is expected to increase by 5% per year in the following 3 years. Okay. So this is gonna be this into 1.05 into 1.05 and into 1.05. This is what it is going to be. So you've got the profit before interest and tax on both of them, on all of them. You apply tax on them directly. Tax at the rate of 18%. When you apply tax on them directly, you don't have to add back after tax interest. It says that you apply tax on them directly. Now what happens is that the depreciation, which is usually added back, and the investment, which is minus, need not to be done. Additional investment. The additional investment. How much is the additional investment that you need to make? 2.7 million will be required in year one, and then 2.13 per $1 increase in PBIT from year 2 to 4. 2.7 million. This minus this multiply by 2.13. See, this is what we have done because divide by 1 for every $1 increase. This is what it has to be done. Now what we are going to do is that we are going to copy this and we're going to paste it here. We're going to paste it here. Right? Okay. Free cash flows to firm. It's actually going to be like this. Then what happens is that we are being told that there is additional 9.2 million per year in each of the first 4 years. Additional amount 9.2, 9.2, 9.2, 9.2. So hence resultingly what happens is that just checking why is the bottom border not working. Okay, there's something wrong with my working or I don't know. Okay, it's working now. Cancel. Let me just try to put it again. Cells, alignment, no border. None. Okay, I don't know what sort of adjustment has happened. Now let's move a bit forward and see. These are the cash flows. These are the cash flows, the discount factor, and then the present value. So this is what it is going to be. Now, what is the discount factor? It's 11.92%, right? So what would happen is that you would say this is gonna be 1 plus this power minus 1. Now, what would you do? You would actually lock it up. So in order to lock up this cell, you have to actually apply the dollar sign both sides. And then what you could just do is that you could just copy it. You could just paste it across. Now what's going to happen is that you would say that these are the cash flows that we have. The present value of these cash flows is going to be what? Is going to be this into this. Hence, resultingly, this is what we have got. So just because it's like getting into too many decimal places, so I'm just rounding it off to the nearest decimal places. This is what it has become now. Now, so what happens is that the value of entity using FCFE, the free cash flows to equity, present value of year 1 till 4 is gonna be the sum of all of this. And then there is this terminal value where we are being told that they're gonna increase by 3% for the foreseeable future. So it's actually gonna be like this. You'd have to use the free cash flows before this additional amount. Multiply 1.03 and then divided by 11.92 minus 0.03. That's one working. But there has to be additional working also. And what is that additional working going to be? The additional working is going to be, you have to say that we have to multiply it with the year 4 PV factor also. Because you got to bring it to year 0 level. So hence resultingly what would happen is that you got to multiply this with this. Hence the total value becomes this. 258.2414. Now value of combined company. Value of combined company. This is the value of combined company. Less value of debt at 30%. So you'll end up getting the value of equity. Because this is actually the value of the whole company, right? So this plus this 180.769 is gonna be the value of equity. Now since the examiner requires us to calculate the increase in value less Joshua value, appraiser equity value, so you'll end up getting the increase in equity value is gonna be this minus this minus this. It's 102, sorry, 102, 54 or 58. How much is it? 56. So hence increase in the equity value will be this much. Increase in the equity value would be this much. Let me know if let me know if you do understand this. Yeah, please let me know if you people understand this. If there are any questions, do let me know. Okay, terminal value is ultimately, you see the cash flows that are gonna arise up till the infinity, because the formula is generally FC FE divided by KE or the WACC minus G. That's what generally the formula is. So whatever the future cash flow is, you got to divide by WACC minus G. Now what have I done? The cash flow for the year 4, 22.63, multiplied it by 1.03, the growth, divided by the WACC minus the growth. And then I had to bring it to year 0 level. So I multiplied with the 4th year PV factor. Yeah, do let me know if you understand this, please. The depreciation. Okay, the major difference between the free cash flows to firm and the free cash flows to equity is that if it would have been a free cash flows to equity, we would have started off with a PAT. We would have started off with a PAT. Number one, we would have used the KE as discount rate and we would have got the value of equity. We would have not got the value of the company. The value of the company includes value of equity and debt both. So we would have got the value of equity. That's what we would have got. Do you get it now? Okay, lovely. We are using, no, we cannot use here the FCFE. I'm sorry, I just put FCFE. We have to use FCFF. You know why? The reason being that with respect to the FCFF, you actually are being provided this, I mean, like we are not being given the interest amount here. We're just being given the PBIT, plus we have the WACC. So we have to use the WACC as a discount rate here of the combined company. I mean, like this information was not sufficiently available for us to be able to calculate FCFE. If I would have been able to calculate the profit after tax correctly, I might have actually used the FCFE because I could have then discounted the cash flow using the KE. Okay, I'll just go over. Could you repeat that, please? The point when you use the PAT. Okay, let me just guide you people. Okay, I didn't know that this was such a weak area. Okay, just a minute. Just a second, huh? Okay, let me just explain to you people. that what is the difference between these FCFE, FCFF. Let me just explain to you. See, what actually happens is that when we talk about the free cash flows to firm, this is free cash flows to firm. They are the cash flows available for distribution to providers of finance, that is debt and equity providers. So what actually happens is that we say profit before interest and tax. We say tax on it. Let's say, for example, if it was 100,000, and if I say tax at the rate of 20%, so this is 20,000. So hence I get 80,000 as the PBIT 1 minus T. I'll just guide you what is actually there. Now we multiply it with the weighted average cost of capital as a discount rate. So hence we get the value of firm. The value of firm includes the value of equity plus the value of debt. That's one thing. Now let's just take another example. Assume that you as a company had PBIT was 100,000. The interest was 40,000. So this would have been 60,000, right? The tax at the rate of 20% would have been 12,000, let's say. So hence the profit after tax would have been 48,000. Now, for the free cash flows to equity, one of the approaches you use the PBIT and you apply the tax on it directly. The other approach is you start off with a PAT, let's say 48,000, and you say after tax interest needs to be added up. Means 40,000 is the interest, 1 minus T, 1 minus 0.2, means 1 minus 0.8. So 40,000 into 8 gives you 32,000. You would still reach 80,000. So the examiner actually requires you to calculate free cash flows to equity. So one of the methods that you can use is this method. And the other methods that you can use is this method. These are the two methods that you can use. These are the two methods that you can use. Right? Okay, so I think that the issue with respect to this is now clear. Now, if it would have been free cash flows to firm, if it would have been free cash flows to equity, that is that would actually means that we are calculating the cash available for distribution to equity providers. How would we do that? Do it like this. We would say simply the profit after tax could be your starting point. And then what you could do is that, let's say, whatever the depreciation that you have, you added up there. The non-current asset investment, you're going to minus into that, and you will actually get this. So the major difference between them is with the free cash flows to firm, we calculate the cash flows which is going to be available for distribution to the providers of uh, uh, all finance providers. And for the free cash flows to equity, we make the cash available for the equity providers. Now there is one more aspect which is some of the students are asking for, the concept of terminal value. Now let me just guide you what is this terminal value going to be. So when I talk about the terminal value is going to be, let's say, for example, uh, you have cash flows, year one, year two, year three. You have these cash 1,000, 2,000, 5,000, let's say. Whatever the discount factor is, let's say 10%. So it's like 910, 3750, 1660. We've got these cash flows, right? Now let's just try to understand something. Basically, what happens is that if he tells us now the examiner tells us that look, year one, year two, year three, you have established that the present value of the cash flows is this, this, and this. So we've been able to get the value as 6320. But now from year 4 till infinity is saying that you are going to continue getting 5,000 each year. So you have to multiply it with 1 plus r, divided by 1 upon r perpetuity factor, 1 upon 10%. So what happens is that you end up getting 50,000. But you know what? The problem with this 50,000 is that this is at year 3 level. You have to bring it at year 0 level. How would you do it? You would not do it like this. You would say 5,000 multiply 1 upon 10% multiply by the year 3 PV factor, which is 0.75. Then you will get the answer. So 37,500. So you would say that the value of this company is going to be this plus this. Then you will end up getting the value of the company. 43,820. You'll end up getting the value of the company like this. So this is what the concept of terminal value. Now let me just guide you one more thing. What happens is that the scenario could be a bit different. The examiner might actually say that the cash flows, I mean, like the examiner might actually say, copy. Let's say the examiner might actually say that the cash flows will grow by 2% each year till infinity. So what are you gonna do then? You're gonna say, okay, if they are expected to grow by 2% up till the infinity, so we know that year 1 till 3 what the cash flows are. We have calculated them as the present value to be 6320. But from year 4 till infinity, how the calculations is gonna be 5,000, that's the cash flow, multiply 1.02. Because the cash flow is expected to grow by 2%, right? The cash flow is expected to grow by 2%. And then you're gonna divide it by WACC, which is the 10% minus G, which is 2%. And then obviously you have to bring it to the year 3 level. So it's a multiply by 0.75. It's a multiply by 0.75. So what is that actually gonna be? You're gonna say 5,000 into 1.02 divided by 8% multiply by 0.75 gives you 4781.3. Hence resultingly 54,133 is gonna be the value of the company. 54,133 is gonna be the value of the company. That's how things are gonna be. Is that okay now? Okay, lovely, alhamdulillah. Now let's move a bit forward. I didn't actually have an idea that this was such a problematic area for you people, or else I would have explained it earlier already before getting into this. Okay. Okay, now what happens is that we have now got this value of this company. So the increase in equity value is 22.769 million, right? The increase in the equity value is this 22.769 million. Now what next is there? What is this part of the, okay, the additional, because you see what happens is that the examiner required you to calculate additional value to the shareholders. The additional value to the shareholders through the proposed acquisition will be $22.9 million. Now, next it says that compares the shareholder wealth before and after acquisition by calculating percentage change in equity value and the next year's dividend income for both companies' shareholders. So now what's this specific thing? So can you just read through it and can you just give it a try, please? Can you just read through it and give it a try? Okay, now the CEO's proposal for a share exchange will involve one Fraser company share being exchanged for 3 Joshua company shares. So for 3 Joshua, based on last, the board believes that it has a good understanding of Fraser's expectations. You have therefore been asked to incorporate a minimum acquisition premium of 35% into your analysis, which is the same premium which was requested last year. Okay, now what next is there? It says Fraser Company's founder and majority shareholder is unlikely to approve an acquisition offer on terms which would lead to a reduction in annual dividend. However, Joshua's debt includes a covenant restricting the dividend payments to 25% of each year's free cash flows to firm. Now what next is there? It says the board has therefore also asked for an evaluation of the impact of the proposed terms on the next year forecast pre-acquisition dividend for both companies' shareholders. So what have they actually asked you to do? They've actually asked you to do the calculations according to these. Now, what happens is that the examiner is actually asking you to, I repeat, the examiner is actually asking you to compare the shareholder wealth before and after acquisition by calculating percentage change in the equity value and the next year's dividend income for both companies' shareholders. So let's just come back to it again. Joshua had 40 million shares. Fraser had 10 million shares. Market value of equity was this. Market value of equity is this. The total dividends were these. The total dividends were these. Now, what is the approach that you're going to adopt? Okay, Shahir Karim, that's one final thing. See, there are always, when you come across such a question, just make sure that you split the requirement. Compare shareholder wealth before and after the acquisition by calculating percentage change in equity value. So shareholder wealth before and after the acquisition by calculating the percentage change in equity value and the next year's dividend income for both companies' shareholders. Now see what is going to happen. The total number of shares that will be owned by each group of shareholders is going to be like this. So the total number of shares that are going to be owned by each group of shareholders is going to be like this. Joshua, Fraser. So Joshua's shares would be the same. It's like $40 million, 40 shares. 40, and here it is gonna become 30 because we're gonna be giving 33 shares for every 1 share. Sum. This is what the total number of shares. The value per share. Okay. Value of Joshua. Okay, this is basically gonna be the total value. Total value is gonna be value per share is gonna be this divided by this. So the value per share has now become 2.58. Now what do you need to do? You need to say that existing value per share of Joshua is how much? 102 million was the value of the Joshua and 40 million shares. Revised value of a shareholder is actually this. So increase in value is this minus this. Percentage change is gonna be this divided by this. So this is what you will get. So basically we have been able to calculate for the Joshua company, the percentage change in the value of the shares is 1.27% for the Joshua company shareholders. For the Joshua shareholders. Now let's talk about the other one. The other company is, I repeat, the other company is Fraser Company. The existing value is gonna be 58 divided by 10. 56 divided by 10. Right? Revised value of a shareholder. Now it's gonna be 3 shares. So it's going to be this multiplied by 3. Hence the increase in value is this, and the increase in value in terms of percentages is this. So the question's requirement again was that we had to compare shareholder wealth before and after acquisition by calculating percentage change in equity value. And next year's dividend income for both companies shareholders. Okay, now let's just try to do about the dividend also, because there were some technicalities with respect to dividend. Okay, dividend payments has to be restricted to 25% of each year's free cash flows to firm. The board has requested for an evaluation of impact of the proposed terms on next year forecast acquisition, post-acquisition dividend for both companies shareholders. Okay. So the maximum dividends for next year is 25% multiplied by I just need to see that what was this additional amount. Let me just a minute. Okay, I'm actually just assuming that it is not like this. It has to be on the basis of free cash flows. If let's say it's on the basis of free cash flows to firm, this is what it is, 4.901. Dividend for Joshua shares. Okay, dividend per share. Dividend for Joshua original shareholders. Dividend for Fraser original shareholder. So the dividend per share is gonna be what? This is 4.901 divided by the number of shares, which is 70 million. Dividend for Joshua original share, this multiply by 40 million is the shares that the Joshua's original shareholders have. Fraser original shareholders have got 30 million shares now. So dividend for them is gonna be this. Now see, original dividend was 2.7. It is 2.8. The original dividend for Joshua was Fraser was 3.2, and it has become 2.1 now. I've done the calculation on the basis of assuming that the free cash flows ignore the tax synergies. But if I incorporate the tax synergies, the situation would be slightly different. The situation would be slightly different. So the existing dividend was 2.7 and 3.2. Hence, increase or decrease in dividend is gonna be like this. Okay, I'm just gonna repeat it. I'm just gonna repeat each step. See, Joshua's shareholder would have their own shares, 40 million. The Fraser company shareholders are now gonna be given 3 shares for every 1 share that they had. So there were actually 10 million shares. Multiply by 3 divided by 1 for every 1 share. The 3 shares have been given. Right? So total number of shares becomes 70 million. The value is already you have calculated, value per share is here. Now, if you want to calculate the percentage change, so the existing value per Joshua share is 2.55. The revised value for the shareholder is this. The increase in value is the difference between these two values. And hence we have the percentage change on the basis of the existing value. Same goes here for the Fraser also, that originally it was 56 million divided by 10. Now each one single shareholder had a 3 shares now. So there's the increase in value of this. This is the percentage change of this. Okay, revised share value is quite simple. It's basically the revised value per share. How do you calculate? The value divided by number of shares. How did I get this? Because they say that you can maximum pay out 25% of the dividend. So I've just used the free cash flows and I multiplied it by 25%. Yeah, kindly look at it and let me know if there is still any issue that you people are having. revised value. What is the FCFF figure? Where do you come to FCFF figure? 7.27. Okay, here you go. The value, which is 2.5824, multiply by 3. Okay, how could you show revised Joshua share value calculation? Okay, it's here. See, this is what it is. It's the same thing because the value of the share is now 180.76 that we calculated the value of equity. Divide by total number of shares, it's 70 million. Then what actually happens is that, okay, there is this additional query. Can you please go over the dividend? Okay, yes, I'll just do. See, the examiner says you could maximum pay 25% dividend of the free cash flows. So 25% of the free cash flows is what you have, right? Then in addition to this, uh, you would divide it by the number of shares, which is 70 million. You get the dividend per share. So the original dividend for Joshua original share. See, the number of shares that Joshua has is 40 million. The number of shares that Fraser people have got is 30 million. So 30 million this. The existing dividend is this. The dividend for the Joshua is increasing. The dividend for Fraser is cumulatively decreasing. Now, do you get my point? Now, what next is there? So requirement was compare shareholder vault, so and so, so and so. Advise the board of any concern either company shareholder may have with the acquisition and discuss the validity of the assumptions made in the proposals and discuss credibility of the CEO's alternative. Now, same thing. See, there was one more point over here, and I think it was okay. Now, then there is this word processor. I'll just go on to. It says advise the board of the concerns either company shareholders may have with the acquisition and discuss validity of assumptions. See, cumulative dividend for Fraser is decreasing. Fraser shareholders are concerned about this decrease in dividend because they have not compromised on that. The shareholders of Fraser may not agree to all equity transaction and may require cash to be paid. The synergies may not arise. The WACC calculation is an approximate. The estimated asset beta is a good approximate of the asset beta. So like these are the things that are probably gonna be there. I repeat, these are the things that are probably gonna be there. But just make sure that you don't just list down, you actually explain them, you elaborate them. So like list the different assumptions used in pre-cash flows should also be discussed. I'm just giving you a hint. I'm just giving an idea. 8 points, 8 marks. Yes, you can easily do 8 marks over here. And you could just keep on discussing each one of them a bit. So you can easily do it in here. Now let's just talk about the last part of the question, that what is this last part of the question? Last part of the question is discuss the credibility of the suggestions of the share buyback. Now, as yet there have been no formal takeovers for Joshua. The board wants to be fully prepared in case this changes. Particularly in their own takeover of Fraser is not visible. Directors have been attending a series of seminars on alternative takeover defensive and would like to discuss the findings at the next board meeting. Topics would be discussed include possibility of using a share buyback as a defense tactic. This would involve Joshua buying and canceling some of its own shares. Joshua has asked for advice on credibility of such a defense and would like to discuss the effect on the company's earning per share, cost of capital, and share price, amongst other issues. In the context of company's liquidity problems, further bank owned, which has imposed a restriction on what the assets could be disposed of. Now see, what happens is that if you talk about the impact on EPS, so it increases. Impact on share price, it increases. What other impacts are they talking about? For the cost of capital, it will decrease as the equity element would reduce a bit and hence the risk premium also changes. The suggestion is vague as company is already short of cash flows. Plus additionally, the assets cannot be disposed of. Hence the cash cannot be generated from alternative sources. The share buyback is a good defense strategy, but may not work out well in the case of Joshua. Do you people get it? Yeah, do you people get it? Okay. So we are done with this question, the name of which was Joshua Company. And this was an amazing question on the mergers and acquisition, which actually required you to calculate the value of the company plus the impacts on the value of the company. So there were quite a few good things about this specific question, and this is a very comprehensive question. And I hope that you people would have also got a good insight into the mergers and acquisition and how to handle this scenario in the examination. Okay, about the premium of 35%, if you could see, we have already given them 38.34% increase on the value. So the 35% premium is already embedded. Even after that, they're getting a 3.34% additional return, additional gain. Okay. So um, what actually happens in share buyback is that you tell your existing shareholders that, okay, what we want you to do is that if you could just allow us to buy back the shares, we would give you an X amount of money. So automatically the number of shares that are there in the market, they actually reduces. And when the number of shares reduces, so automatically the EPS increases, and hence that has a favorable impact on your share prices. So that's what actually happens, right? Right? Okay. So we just keep it till here. And inshallah, tomorrow we meet up again. I'm just gonna take out time. Um, I'll just let you know in advance that what time are we gonna be meeting up. But it won't be late in the evening. It would be maximum 6 or 7 p.m. because I have to have some family event I mean, like I have to reach there at 9 p.m., something like that. So I would have to actually end up by 9. So I would try to cover a few things. There are some specific requests pertaining to some areas, which I'll be covering off tomorrow. So don't worry about it. Everything is important, Shahir Karim. Don't worry. Okay, thank you guys. Thank you for attending the session. I hope that you enjoyed the session and it was fruitful for all of you. Getting the insights of how these are to be done. Yes, you will be informed. It will be around 6:30 or 7 p.m. Pakistan time that I'll start off, inshallah.